If you're currently receiving a Affordable Care Health Subsidy, then you'll want to watch this video as I'll be discussing some potential changes that are on the horizon for those health care subsidies in 2026 and some things that you can do to give yourself a chance to continue with that subsidy. Welcome back. This is episode 267. Retirees often wonder how they will afford health insurance if they retire before age 65 because of the high cost of monthly premiums and the deductibles of health insurance. The Affordable Care Act, known as the ACA or Obamacare, provides subsidies to those qualifying individuals and families to help them make their health insurance more affordable. And many retirees have been able to find affordable health insurance thanks to these generous subsidies that are now available. However, these generous subsidies are scheduled to end in 2026, and retirees will need to be aware of the way these subsidies will be calculated going forward and things that they can do to continue their subsidies. In this episode, I'm going to talk about how the subsidies are currently calculated, what those potential changes are that will be occurring in 2026, and some strategies that you can use to continue or make yourself eligible for a subsidy in 2026. First of all, what are ACA or Affordable Care Act tax subsidies? ACA subsidies are tax credits available to many people whose net income is between 100% and 400% of the federal poverty level. And I'll talk about those numbers in a minute. But the ACA subsidies go towards paying the health insurance premiums for those who otherwise might struggle to afford health insurance. ACA subsidized people are often shielded from rising premiums, as ACA subsidies usually increase or decrease in proportion to the premiums. This helps keep health insurance affordable for people with lower to middle income. In 2024, approximately 91% of the 21 million people who purchase health insurance through the marketplace or the Affordable Care Exchange received some type of ACA premium subsidy, according to the Centers for Medicare and Medicaid. And this was an increase of 30% over the prior year. What is the current eligibility? As I mentioned before, Obamacare offers subsidies known as tax credits that work on a sliding scale, and they limit the amount you pay in monthly premiums to a percentage of your annual income. And most people are eligible for subsidies when they earn between 100 and 400% of the federal poverty level. That's also based on their household size. However, the American Rescue Plan, ARPA, signed into law on March 11th of 2021, has given temporary relief to many Americans who were struggling to find affordable health insurance during the economic pandemic caused by COVID-19. This subsidy was extended even beyond COVID-19, and that is what is set to expire at the end of 2025. Retirees and just anyone in general who qualifies for this subsidy has been able to take advantage of these generous subsidies that were much more lenient than they were before the signing of the American Rescue Plan Act. To be eligible for these subsidies, a couple things have to be in play. Any non-citizen or legally present non-citizen who doesn't have access to otherwise affordable health insurance, example from Medicare, will pay no more than 8.5% of their income for a marketplace silver plan. Most people who receive at least 1 week of unemployment compensation at any time in 2021 were able to obtain a silver plan with zero premiums and cost sharing reductions. And then individuals who earn 500% of the federal poverty level and don't have access to other affordable health insurance may take advantage of certain cost-sharing reductions on marketplace plans available to people with lower incomes. Additionally, if your income is below 138% of the federal poverty level, most states have expanded Medicaid, which would allow you to qualify for Medicaid based on your income. If your income falls below the federal poverty level, you may not qualify for subsidies, but you're likely to qualify for Medicaid. That's what you've been hearing about, the expansion of Medicaid. That's where a lot of people have been going on Medicaid. To qualify for Obamacare subsidies, you must meet the following criteria. You must live in the U.S. currently, you must be a U.S. citizen or legal resident, you can't be incarcerated, and your income can be no more than 400% of the federal poverty level, except for the case of the American Rescue Recovery Act, which extended this up to 500%. The current federal poverty level for an individual is $15,650. Based on the number of individuals in your household, that then increases the federal poverty level. Now, this is the federal poverty level for the 48 continental U.S. states. There's a different federal poverty level for Alaska and Hawaii. Those are higher levels, so you'd have to check with those if you live with one of those states. And then these are adjusted every year for inflation. For a single individual, as I mentioned, the initial federal poverty level, or 100% of it, is $15,650, but 400% of that is $60,640. For a two-family or two-person household, the federal poverty level is $21,150. For a couple, 400% of that would be $84,600. And then I'll stop at a three-person household is $26,650. And then 400% of that is $106,600. In 2025, for every additional member of your household, it increases the federal poverty level by $5,500. This is then used to calculate the potential subsidy that you're eligible for. When can you sign up? You can sign up at any point during the open enrollment period, which is from November 1st until January 15th. So it's coming up. If you don't enroll during the open enrollment period, then you may qualify during the special enrollment period. But to be eligible for special enrollment, you qualify if you or anyone in your household had the following things happen in the past 60 days. You got married, you had a baby, adopted a child, or placed a child for foster care, you got divorced, legally separated, or you lost your health insurance, and somebody passed away. These are some of the reasons why you could become eligible outside of the open enrollment period. And also, if you change your resident, you may be eligible for special enrollment periods. If you move to a new zip code or county, if you move to the U.S. from a foreign country, if you're a student moving to a new place to attend school, if you're a seasonal worker moving from place to place to live and work, or if you're moving to or from a shelter or a transitional housing. Additionally, as I said earlier, if you lose your health insurance, that would allow you for special enrollment. How do these subsidies work? There's two kinds of subsidies. The more common is the advance premium credit, which can help you pay the ACA health insurance premiums purchased on the marketplace throughout the year. If you qualify based on your projected income, you can either take the tax credit throughout the year that will be paid directly to the health insurer to offset the premium that you'd otherwise pay, or you can pay the premium in full each month, and then you receive your tax credit when you file your income tax. I would say most people are using the tax credit to offset their monthly premium. To get health insurance, you generally need to buy this through one of the health exchanges that if your state has their own health exchange, you can use that. Or if your state doesn't have their own health exchange, then you go to the federal healthcare exchange. Another thing to realize is that if you take the tax credit each month and you underestimate your actual income, you will owe some of this advanced money back at the end of the year. On the other hand, if you overestimate your income, you'll receive an adjusted tax credit refund when you file your income tax return. To avoid this issue, it's a good idea to report any changes to your income by updating your marketplace application or contacting your marketplace call center. It's also important to know that tax credit subsidies apply to ACA plans you purchase on the marketplace. So it's a good idea to make sure that you get your plan through the marketplace. The second type of ACA subsidy is called the cost sharing reduction subsidy. And if you're eligible, this can reduce your out-of-pocket costs for services by paying a portion of your deductible, co-payment, or co-insurance. What should you know about these subsidies? Anyone who's curious about these subsidies needs to know the following. Your eligibility is based on your income in the year in which you're covered by your health plan, not your income as reported by last year's tax return. This means that it's important to estimate your income when applying for subsidies. And this includes employment income, Social Security, pensions, retirement plan distributions, interest from savings, dividends. Any money that would normally be calculated as part of your modified adjusted gross income goes into this calculation. You don't want to underestimate your income, then earn more, and then find out that you have to pay back a large portion of your subsidy, because this could be difficult for anybody's cash flow if all of a sudden you need to pay back $5,000 at the end of the year because you underestimated your income. So it's really important that you have a good handle on your income, working with your financial advisor, working with your CPA, to get an idea of what your income's going to be. As I said before, you want to apply for your health insurance through one of the marketplaces. In my home state of Connecticut, our marketplace is accesshealthct.gov. And if your state doesn't have their own marketplace, then you can go to healthcare.gov to apply. And if you want to get some idea of pricing, it's a great idea to go to those websites and you can put in your income, projected income, your household size, where you live, and you'll get some information about pricing. So these subsidies are going back based on the size of your household level. For example, I mentioned a single individual. You're capped out at a subsidy at 400% of the federal poverty level. So 400% of the federal poverty level for a single individual is $60,640. So that means that if you go $1 over that level, you completely lose your subsidy. The way the current subsidies work is that they're a gradual decrease. The way they worked before is they are a cliff. And when you go over that cliff, that's it. You completely lose your subsidy. So it's extremely important that if you qualify for a subsidy, that you keep an eye on your income and you don't end up going over the number and therefore losing your subsidy. As a married couple, your limit would be $84,600. So that is a low amount of income for some people, and it's definitely something you need to plan for as far as how you're going to generate your income to live. If you need more income than that to pay your bills, then you might have to take it from different places to be eligible to receive that subsidy. And now keep in mind, these subsidies go away when you turn 65 because then you'd go on Medicare. So for a retiree, it's really about how can you bridge the gap between your late 50s to 65, maybe early 60s, to get reasonably priced health insurance and qualify for these subsidies. Now, these subsidies are not based off of assets. You could have millions of dollars in retirement accounts, but if you weren't withdrawing from them, or you weren't collecting an income from those, or you were collecting an income that kept you underneath the federal poverty level for your household size, then you are eligible for the subsidy. That's how the subsidies are structured. That's how Congress has set them up. There's no income test. It's really up to you if you personally feel okay doing it, but it's available for everyone based off your income, not based off your assets. Now, next year, it's also projected from articles I've been reading that because these premiums are going back to the way, or these subsidies are going back to the way they were before, that insurers already know that there are going to be a lot of people that are going to be falling off of their plans. And they are projecting that it's going to be healthier people that are leaving their plans, and meaning that they're going to have more claims. I'm seeing articles that are saying that insurers are going to be raising premiums already anywhere from 15 to 30% for 2026, and that is not even factoring in any loss of health of the subsidies. So that's an increase in premiums. Let's talk about some numbers and examples of what these subsidies could be worth to you. I went on my own health insurance website, accesshealthcare.gov, and I put in what would the premium be for a 63-year-old couple living in it's based on your county as well, in New Haven County where I live, with $80,000 of modified adjusted gross income. They would be eligible for a subsidy of $2,614. And the bronze health insurance plan, which is the lowest plan that you could buy, is because it has the highest deductible and the lowest amount of coverage, would be $98 a month. If you wanted health insurance for a catastrophic reason, you go into the hospital, have a bad illness, it's going to be $98 per month. A silver plan would be $465 per month. Very affordable, probably, for this couple. I then increased the adjusted gross income to $100,000. They would still qualify for a subsidy of $2,458. And the bronze plan would then be $245 a month. And then the silver plan, which, if I didn't mention earlier, is one of the highest plans you can get, most comprehensive, lower deductible, would be $715 a month. But again, these are 2026 numbers. So if this couple in this example's income next year was actually $100,000 and Congress does nothing to change these subsidies, they just let this expire and they let them go back to the old way they're being calculated, then this couple would not get any subsidy. So their total out-of-pocket cost for a bronze plan with no subsidy would be $2,700 a month, and for the silver plan would be $3,070 a month. So that gives you some perspective, is that if you're a couple that's going to have $200,000 a year of income next year, how much might you have to pay for health insurance on the exchange? And that would be $2,700 a month for a bronze plan, $3,000 a month for a silver, and that's a combined premium. So it is definitely an expensive cost. Now, depending on your state, there might be health insurance options that are offered off the healthcare exchange. Where I live in Connecticut, there are very few that are, but some states have more options that could have even a lower premium than what's available on the exchange, because the exchange plans are required to have certain things that maybe off-exchange plans aren't. So you could look into that to see if that's available to you, but we have to wait and see what Congress is going to do if they're going to extend this. I'm not sure. This wasn't a part of the One Big Beautiful Bill Act. There was nothing mentioned in this about this. So this would be a separate bill that Congress would have to pass, and maybe they aren't going to. Again, this was created in 2021, and the health insurance affordable health exchanges worked for many years without these subsidies being ramped up, being multiplied. So maybe this is going to be the new normal. So let's assume that these subsidies don't get extended in their current form past 2025, and they go back to the old way that they're currently being calculated. So what can you do as a retiree? Let's say you're in your early 60s, you want to qualify for the maximum subsidy, which would mean you'd need to stay underneath 400% of your federal poverty level based off your household size. Assuming the federal poverty levels don't change by next year, then as a single individual, you need to stay below $60,640, and as a married couple, $84,600. So what can you do to keep your income below that? Well, you could take more income now. You could take extra income in 2025 knowing that maybe you're on a subsidy and maybe you just lessen what you get this year, knowing you're going to get a subsidy next year, whereas if you didn't take more this year, you'd get nothing next year. You could take more income. You could take IRA distributions this year, set that money aside. Maybe that covers you for a couple of years of subsidies. You could realize capital gains on stocks. If you have rental properties, you could sell them. You could essentially make assets available so that they're there for you to draw off of those assets. That's not going to create income. Remember, if you take distributions this year and you put that money into the bank and let it collect some interest and you draw off of what you need, the only income you're paying tax on is the interest you receive on that money. The actual using of that money is not income. Those are some things that you could do. Essentially, you're building up your cash to be able to use, to draw off of and live on, and then qualify for the subsidy. You also could get a home equity line of credit. It's not the best idea, but it's a way that you could tap into equity in your home. You are going to pay some interest to do that, but then you could use that for a couple years. Then when you no longer qualify for the subsidy, you could then take out some greater distributions and pay off that home equity line of credit. You could do a reverse mortgage too, as well. That's another way to tap into equity in your home. You also could take Roth distributions. Anytime you're taking distributions from a Roth 401k, a Roth IRA, as long as you've had that account open for 5 years and you're older than 59 and a half, there's no taxes due on those distributions. And even if you haven't had the account open for 5 years, you could always take out your contributions first, and those aren't taxable. That's another idea. If you're somebody who's still working and you want to maybe retire or work part-time, and you still want to qualify for a subsidy, and you still have access to retirement plan through work, anytime you make 401k contributions, you make HSA contributions, IRA contributions, these are all pre-tax contributions. This is reducing your taxable income. So that's also lowering your modified adjusted gross income. As a retiree, you're probably not going to have access to making contributions because you need earned income. You need to either work for someone and collect a W-2 and be eligible for their retirement plan, or you need to have some self-employed income, a small business, some consulting business, where then you could set up a self-employed 401k, a solo 401k, or contribute to a traditional IRA and be able to make those contributions, or an HSA as well. Those are definitely some ideas and things that you can do if you're somebody who's working to lower your adjusted gross income so that you could then qualify for that subsidy. And lastly, because We don't know exactly what's going to happen. We still have some time remaining in the year. Check back and see if Congress actually does anything. And if they do or they don't, you should still check back during the open enrollment, which starts in November. If you're somebody who's retiring next year and you want to see what your potential ACA subsidy will be for next year, they should have the numbers by then so that you can project out for what they will be next year. Because it's a good idea to, if you want to just see generally what the subsidies look like, you could go online right now to your health insurance marketplace for your state. But these numbers they're using now are 2025 numbers. They're not 2026. So you need to wait and come back until November, between November and the end of the year, to see what those subsidies will look like. I hope this was helpful about understanding how the current subsidies work and those potential changes that are coming next year and some things that you can do to still take advantage of those subsidies. And you could always reach out to us if you're looking for help with that as well. And as always, if you have a listener question you want to have considered for your future episode, head over to retirewithryan.com and click on Ask a Question. Have a great week, and I look forward to talking to you next Tuesday. Take care.